Welcome to Invoice Finance Explained by Market Invoice. I'm Adam Parker, and I'm here with Oliver Mackman to break down how invoice finance actually works for UK businesses. Today, we're starting with the basics: what invoice finance is, when it makes sense, and when it doesn't.
Right, and we're going to keep this practical. No jargon, no sales pitch. Just what a business owner actually needs to know when they're looking at their cash flow and wondering if invoice finance might help. Exactly. So let's start simple.
Invoice finance is essentially borrowing against money your customers already owe you. Instead of waiting 30, 60, or 90 days for payment, you can access typically 70 to 90% of that invoice value within 24 hours.
And that sounds great in theory, but let's get specific. Say I'm running a $500K turnover recruitment agency, and I've got $50K tied up in invoices that won't be paid for 6 weeks. What are my actual options?
You'd typically be looking at either factoring or invoice discounting. With factoring, the finance company takes over your credit control. They chase the payments. With invoice discounting, you keep control of collections, but you need stronger internal systems.
So factoring means my customers know I'm using finance. Invoice discounting, they don't.
Usually, yes, though some providers offer confidential factoring where payments still go to your account initially. The trade-off is that factoring tends to be slightly more expensive because you're paying for that credit control service. What does slightly more expensive actually mean? Because when you're cash-strapped, every percentage point matters. Fair point. We typically see factoring at around 1.5 to 3% per month on the advanced amount, while invoice discounting might be 1 to 2.5%. But there are usually facility fees, setup costs, and sometimes audit fees are top.
So on that $50K example, I could be looking at £750 to £1,500 per month just in finance charges?
Potentially, yes. Though remember, you're only paying on the money you actually draw down and only for the time you use it. If your customer pays in 3 weeks instead of 6, your costs drop accordingly. That's important context, but when does this actually make sense? Because those costs aren't trivial for most SMEs. The classic scenario is growth. If you're a construction company that's just won a big contract but needs to pay suppliers and staff before you get paid, that finance cost might be worth it to secure the revenue. Or in recruitment, where you might have 40 contractors to pay weekly, but client payments come in monthly. The alternative could be losing good people or missing out on contracts entirely. Exactly. We've seen businesses through Market Invoice who were turning down work because they couldn't fund the cash flow gap. The finance costs become irrelevant if they enable you to grow revenue. But there's a flip side, isn't there? I've heard horror stories about businesses getting locked into expensive contracts when they were desperate. Unfortunately, yes. The key red flags are minimum commitment periods over 12 months, personal guarantees that extend beyond reasonable limits, and termination fees that make it impossible to switch providers. What about the approval process? How quickly can a business actually access this funding when they need it? Most established providers, Bibby, Close Brothers, IGF, can make decisions within a few days for straightforward applications. The limiting factor is usually how quickly you can provide the financial information they need. And what are they actually looking for? Because I imagine it's different from a traditional bank loan. It is. They're primarily assessing the quality of your debtors. Will your customers actually pay? Your own business needs to be profitable and well managed, but they're less concerned about property or other security.
So if I'm selling to Tesco or the NHS, that's probably going to be viewed more favorably than if all my customers are startups.
Absolutely. They'll look at your debtor spread, payment history, any disputes or returns. A manufacturing business selling to established distributors will find it easier than a marketing agency with lots of small clients.
What about sectors where this just doesn't work? I'm thinking hospitality, retail, businesses that get paid immediately.
Right. You need genuine trade debtors. Cash businesses, or those with very short payment cycles, don't have the invoices to finance against, though some hospitality businesses do have corporate contracts that could work.
Let's talk about the day-to-day reality. Once you're set up with a facility, how does it actually work?
You raise an invoice, submit it to the finance company, usually through an online portal, and they advance 80% or so within hours. When your customer pays, they settle the balance minus their fees.
And if a customer doesn't pay or disputes the invoice?
This is crucial. Most facilities are with recourse, meaning ultimately you're liable if the debt goes bad. The finance company will expect you to buy back any invoices that remain unpaid after 90 to 120 days.
So you're not actually transferring the credit risk, just the timing risk.
Exactly. There are non-recourse options, but they're more expensive and often come with restrictions on which invoices qualify.
What about the impact on customer relationships? I'd be worried about a finance company being heavy-handed with collections.
It varies by provider. The larger, more established factoring companies understand that damaging your customer relationships hurts their own interests, but it's worth asking about their collection procedures up front.
Are there any alternatives that might make more sense for certain businesses?
Asset-based lending can work for businesses with stock or equipment. Trade finance might suit importers. And if you just need short-term working capital, a business loan or overdraft might be cheaper.
But presumably those require the security or credit history that many growing businesses don't have?
That's the key point. Invoice finance can work for profitable businesses that banks might not support through traditional lending. We've seen companies with limited trading history access significant facilities based on strong contract pipelines.
What about the size of business where this makes sense? Is there a sweet spot?
Providers like Optimum Finance and Korea will look at businesses from £250,000 turnover upwards, but it typically makes most sense from £500,000 to £10 million. Below that, the costs can be prohibitive. Above that, you have more funding options. And seasonality, how does that work? A garden center that does 70% of its business in spring and summer.
Actually, that's where invoice finance can really shine. You only pay for what you use, so in quiet periods, your costs drop naturally. Compare that to an overdraft where you pay for the facility whether you use it or not.
What should someone do if they think this might be right for their business?
Start by understanding your actual cash flow patterns. Map out when invoices are raised versus when they're paid. Then work out whether the finance costs are justified by the opportunities you could pursue.
And don't just talk to one provider, I'd imagine.
Definitely not. Pricing and terms vary significantly across providers. What works for a manufacturing business might not suit a recruitment agency. The key is matching your specific needs to the right type of facility and provider.
Any final warnings for businesses considering this?
Read the contract carefully, particularly around termination and audit rights. Make sure you understand exactly what you're committing to. And remember, this should support growth, not mask underlying problems with profitability or customer quality.
Because if your margins are already tight, adding finance costs isn't going to solve that fundamental issue.
Exactly. Invoice finance works best for businesses that are profitable but growing, not those that are struggling with basic viability.
So, to summarize, it's a tool for managing growth and timing, not a solution for deeper business problems.
That's a perfect way to put it. Invoice finance can accelerate growth and smooth cash flow for the right business, but it needs to make commercial sense when you look at the total cost versus the opportunities it unlocks.
And the decision should be based on your specific circumstances, industry, and growth plans.
Which is why we always recommend speaking to a regulated advisor who can assess your particular situation. Every business is different, and what works for one might not work for another.
Thanks, Adam. I think we've covered the key points business owners need to understand before they start exploring their options.
Thanks, Oliver. Just to remind listeners, this podcast is for general information only and shouldn't be considered financial advice. Always consult with a regulated professional before making any business financing decisions. You can find more resources and guidance on invoice finance options at https://marketinvoice.co.uk. Next time, we'll be diving deeper into how to compare providers and what questions you should be asking. Thanks for listening to Invoice Finance Explained.